Blueberry Limited sell X phone to its customer on credit terms. It is currently able to sell 120,000 X phones based on average collection period of 20 days. Due to poor economic conditions, Blueberry Limited is considering tighten its credit policy and decrease the average collection period to 12 days to try to improve cash flow. Blueberry Limited will also recruit a team to constantly monitor and visit companies to reduce bad debts. This will cost an additional 18,000 per year. However, this will potentially result in 9% decrease in sales. Bad debt expenses is expected to reduce from 7 to 4%. The selling price is $80 per unit and variable price is $55 per unit. The cost of tying up funds in accounts receivable is 8% per annum. Evaluate the proposed plan and make a recommendation to Blueberry Limited whether the new plan should be implemented. Clue: from the old plan to the new plan, is there an increase or decrease in the three variables? Will this result in additional costs or profits to the firm? Additional profit from increase in sales. New plan. Profit contribution equals to 120k times 0.91 times bracket 80 minus 55 gives you 2.73 million. Old plan. The profit contribution is 120k times bracket 80 minus 55 give you 3 million. The decrease in profit equals to new plan minus old plan. 2.73 mil minus 3 mil gives you a negative 270k profit. Recall, there's a decrease in sales that will lead to a decrease in profit. Cost of marginal investment in AR. New plan. Total variable cost of sales equals to 120k times 0.91 times 55 give you 6.006 million. The accounts receivable turnover equals to 360 divided by 12, okay, equals to 30 times. Average investment in AR is basically 6.006 million divided by 30 gives you 200.2k. The old plan, apply the same principle. Total variable cost of sales equals to 120k times 55 gives you 6.6 mil. Accounts receivable turnover equals to 360 divided by 20 equals to 18 times. Average investment in AR equals to 6.6 million divided by 18 gives you 366,667. Marginal investment in AR equals to 200.2k minus 366,667. It gives you a negative 166,467. So there's a saving here. The saving in marginal investment in AR equals to 166,467 times 8%. It gives you 13,317 dollars. So that in this case, if you tighten the credit policy here, you have a saving in marginal investment in AR. So recall, decrease in investment in AR will lead to an increase in saving or profit. The cost of marginal bad debts. New plan is 4% times 80 times 120K times 0.91 equals to 349,440. Old plan is 7% times 80 times 120,000 equals to 672K. The marginal saving in cost of debts equals to 322,560. So to recall, the decrease in bad debts will result in increase in profits or savings. Additional expenses incurred to collect debts is 18K per year, right? It is basically a hire team to collect the bad debts. So, okay, the increase in profits from implementing the new plan is basically negative 270K plus the 13,317 plus 322,560 minus 18K gives you 47877. So it is recommend to implement the new plan since it leads to increase in profits. Any questions so far? Additional question. Compare against the example provided in lecture notes, which is on relaxing credit standards. Question. Why would bad debts increase when the credit standard is relaxed? Why? Think about it. Answer. When the credit standard is relaxed, it will lead to more account receivables. In turn, it will lead to more bad debts. Why would AR turnover, accounts receivable turnover decrease when the credit standard is relaxed? Think about it. Answer. When the credit standard is relaxed, more days will be in the account. The AR will increase in number of days, and the turnover will naturally decrease. The AR turnover will decrease.